Ira, let's dive in. We're going to do a webinar on infinite banking and helping people grow their money guaranteed and tax-free.
Sounds awesome. Let's do it.
Ira, why don't you share with everyone just a little bit about yourself?
Yeah, thanks, Barry. Thanks for having me. So I've been doing the insurance business about 20 years. And about 18 years ago, I was introduced to a process called LEAP. And LEAP basically takes people through a holistic approach of their overall finances, finds some of the gaps in the areas where maybe it's just a blind spot that people don't realize. And so it was a very unique process. But the interesting thing is I hadn't really done it myself. So I had a gentleman take me through. And once I saw my own plan going through this, and I've been in the business a few years, I realized I was doing it wrong those couple of years. So wrong meaning there's just a different approach to financial success that I just never saw or never even heard. That kind of led me down this path of understanding the use of whole life insurance and infinite banking and how you can create that. So I've spent the last 18 years working with clients, helping them understand that, helping them to set this up for their family, for their legacy, and for the success of their financial world. So it's just been a fun process. It's been fun to partner with you, Barry. You're very knowledgeable on this. And so, yeah, I think it's great that we're doing this webinar so we can help enlighten people and share more of this, because people need to understand and hear this. It works against the common financial planning strategies or common strategies that people use. And so it works, it's effective, and it's guaranteed. So people need to hear this.
Yeah, thank you so much for that, Ira. I agree. I've been in the industry 24 years. And when I first started, I was putting my clients into the stock market, mutual funds, IRAs. And I quickly saw that they were suffering through market volatility. They would call me saying, Barry, why am I losing money? Why am I not making money? And I didn't know what to do because I was so new in the business, but I wanted to find something better. And like you, when I discovered high cash value guaranteed whole life insurance, it was a game changer. I started sleeping well at night. My clients started sleeping well at night. And how good does it feel that we can offer clients guarantees they'll never lose money and they're able to grow that money completely tax-free? It's pretty remarkable.
Yeah, that peace of mind for me sleeping at night, and for my clients to sleep at night, understanding that they're not going to lose money. It's a game changer.
It really is. We want to help everyone out there protect yourselves from future uncertainty. We don't know what's coming down the road. And some of this uncertainty we're talking about are things like taxes, the US debt clock, meaning the US continues to increase the debt load, rising interest rates, stock market, 401k, and retirement problems. I want to pull up the US debt clock. This is staggering. And the reason I like to share this with everyone is because how does the government make money? It's mostly through taxation. And we might think, we've got this amazing 401k, we've got this amazing retirement plan. But what a lot of people don't realize is when they take money out of those plans, they're 100% taxable. And if the government raises taxes in the future, that million or 2 million or 3 million plus that you have in retirement, it's not all your money. So here we are sitting at almost 33 trillion in national debt. But Ira, although this is a huge problem, it's not the main problem. The main problem is down here in the right-hand bottom corner, which is the US unfunded liabilities, almost 193 trillion.
Wow.
What that means is this is the amount of money the US is on the hook for to pay out in the future. So they're never going to be able to pay it, but they're going to try through taxation.
Yeah, therein lies the problem, right? Any of these taxable accounts are the accounts that they're going to have access to for the rest of the existence of those accounts.
That's right. And people need to recognize that these high cash value infinite banking policies allow them to grow money tax-free. So yes, you pay tax on the premiums going in, But all those gains you can now use as your own bank today, but also as a stream of tax-free retirement income.
Yeah, it's awesome.
High cash value whole life insurance is the solution. We're not saying don't ever invest in a 401k, don't ever invest in the stock market. But what we are saying is that you should have in your portfolio a high cash value whole life policy to give you all those benefits that you're not getting elsewhere.
Well, and that's the thing that people don't realize too. And we talk about building this financial house. If you can visualize building this house, the first thing you want to start with is a firm foundation. And sometimes those foundations, if they're built on risk and stock market losses, potentially, they're not stable. You can never build that firm foundation. And that's where I tell my clients, look, let's start a firm foundation with these guaranteed products. So then you do have the ability to do some of these other things as time goes, but you have a firm foundation to build that house.
What a great analogy, Ira. I've often said to someone, if an investment advisor came to you and said, look, I've got an investment for you. I want you to put up all the money. I want you to take all the risk. I'm going to make money, whether you make money or lose money. Is that an investment that you would ever do? And oh, by the way, I'm not going to tell you the outcome, nor am I going to tell you what the taxes will be. You throw up your hands and say, no way would I ever do that investment with you. But what I just described is what most people are doing in their market-based accounts.
Every day. Yep.
What is infinite banking? Infinite banking was created by Nelson Nash. It was the concept that he developed in the 80s. And this is key. It's a uniquely designed, properly structured whole life cash value insurance policy. It must be with a participating dividend paying mutual life insurance company. And this concept is a way for people to become their own bank by taking control of the banking function in their lives. Nelson published the book, Becoming Your Own Banker. We recommend everyone read it. Go to Amazon, go to the Nelson Nash Institute, get a copy of the book, read the book. The financial principles in here, Ira, they're uncommon. They go against the grain, don't they?
They do. And that's where, again, it's a lot of times it's hard for people to be open-minded about these strategies, just because as you do go through this book, it just works against everything we've all been taught, which is the power of it too, because it is doing things differently, which should get people excited about a different strategy.
You're right, Ira. Infinite banking is also known as, there are some other names out there for infinite banking, but be aware that if you ever come across these other names or you talk to financial advisors or maybe even another insurance producer, it doesn't mean you're always getting the right policy. You have to follow the criteria, always meet with an expert. Ira is an expert. Talk with him and let him put your numbers together to show you a properly structured policy. But you'll hear names such as Bank on Yourself, LIRP, which stands for Life Insurance Retirement Plan, cash flow banking, the wealth maximization account, private family banking, all names for infinite banking, but it was Nelson Nash that coined the phrase infinite banking. There have been some offshoots. We always want to make sure that we're using the right company, the right type of policy, the right design, and we must have also the correct writers that we're going to get into here in a few minutes to grow that cash value.
And I'm sure you've seen this over the years as well. I mean, I'll have people come to me and say, hey, I've been introduced to this. And, it sounds like an amazing process and an amazing thing. But when I look at it, I don't really understand it. And so when I look at it with them and go through it, yeah, there are other financial advisors or planners that are giving advice out there. And the planning process, it makes sense, but the product that they use could be very ineffective and have loopholes that the agents just aren't explaining. And so anyway, that's a powerful part of meeting with us and going through this, is we're able to help identify some of those loopholes, even if they are saying they're doing infinite banking.
Yeah, that's exactly right. Well, how do you capitalize on it? How do you establish a plan? I tell people often, we're going to look at your gross annual income, and then you may want to allocate anywhere from 5% to 25% of that to a policy. And Ira will help you go through those numbers and determine what's best for you. Today, we're going to look at premium amounts at $20,000 a year, and we're going to show you how these policies grow and how the cash value is able to be used throughout your life and then also in retirement for income. Ira, what we have here is a $20,000 a year premium on a 42-year-old male, and we're showing him funding the premium through the age of 70. And then at the age of 71, he has the option to either keep putting in the 20,000, he can reduce to the minimum of 4,348, or he could fund some amount in between that. We want people to know that these are flexible premiums. If someone starts a policy at 20,000 a year, they're not locking in to pay 20,000 a year for the rest of their lives.
Yeah, that's been always the concern with some of these, larger premiums. I think any of us, including myself, just would love to have flexibility. Things are going to change anytime, economy can change, jobs can change, anything can change. So having the ability to be flexible is huge. And I love the design of this where you have the ability to put so much in, but drop it back substantially if you had to.
And you nailed it. The flexibility is key. That's going to give the client more peace of mind. And even though we're showing the 20,000 through the age of 70, in any year, they can actually reduce down to that 4,300. And then a couple of years later, if they want to take it back up to the 20, they can do that also.
Yeah, I think it's great, especially right now with the current economy. We are seeing that, where individuals are having to possibly make some adjustments in what they had committed to even years ago and just have that flexibility.
Yeah, I love it. It's just such a peace of mind feature that we add to all of our policies for our clients. If this were traditional old style whole life, when that 20,000 premium goes in, there would be $0 of cash value. But because this policy has a properly structured design, there's over $14,000 of the 20 available in cash value in year one. Ira, do you want to shed some light on what we've done to have all this cash value through the term insurance rider and the paid up additions rider?
Yeah, that's what's able to create this efficiency of the cash value. I'm a visual person. I like to say the base premium, the 4,300, that's like the boat. That's going to get you where you need to go. It's very consistent. It's built well, but it doesn't have a big engine on it or a big sail. Now, that additional amount that you're able to put in that term rider and that the EPPUA rider, that's like putting a massive sail on this boat now. And that's how you get that efficiency. And you get instead of having a 0 in year one, now all of a sudden you have 14,000. And that just continues to compound on top of that each and every year after. But that flexibility in that rider, again, visualize that thing as a sail. When the seas are great and things are going good, keep that thing full mast, fund that full 20,000 in. But if the seas get a little rough, times get tough, you can drop that down and have that flexibility. It's pretty powerful.
Another great analogy, Ira. Thank you. I love that. And what's so cool about this is the money is growing on a guaranteed compound growth curve. So every year you make more money than you did the year prior. This column that says change in total cash value, why this year it went from 23.8, then the next year to 25,195, it's because of that compounding. So you get to year 12, you put in 20,000, your cash value grew by 32,000. You get to year 17, you put in the 20,000, your cash value more than doubled and grew by 42,000.
Where can you put your money into something on a guaranteed basis and double your money, right?
Yeah, it's amazing. Most 60, 65-year-olds that I know, they're not getting this in their portfolio. So to have a predictable stream of growth is remarkable to add to your portfolio. And we want to tell people there's a guaranteed rate of return. And in addition to the guarantee, a dividend is paid. That dividend is not guaranteed. We don't know what the dividend amount will be from one year to the next, but the companies we work with, They've paid dividends every year for over 150 years, over 175 years. You're going to get a dividend. We just don't know what that will be from one year to the next. When a dividend is paid by a mutual insurance company, it's locked in. It can never be taken from you. Some of you out there might be investing in dividend paying stocks. And if you're reinvesting your dividend back into the stock and the stock value goes down, you could lose the dividend. Not in a properly structured whole life policy. Once the dividend is paid, it's locked in.
And that's what I love about working with these big insurance companies. I mean, how many companies do you know that have been around, some of these over 175 years? It's a powerful thing. And they've been consistently paying dividends, even through the tough times, the Depression, World Wars, recessions. They're still paying dividends, which shows the power behind these companies.
Love that. And having that in your portfolio, once again, gives you peace of mind, and people will function better in their lives having a guaranteed tax-free product in their portfolio. I've seen it over and over again, whether it's consciously or subconsciously, Ira, people love and appreciate having this in their portfolio.
Like we said before, they sleep at night knowing there's guarantees and they're not worried about losing money.
Yeah. And we haven't even talked about the recent bank failures, and maybe more are coming. And we're not saying to take your money out of the bank, but add this to your portfolio so you have those other benefits that you're not getting elsewhere. Ira, let's talk a little bit about banking and policy loans. Clients hear that they can use the policy. It is called infinite banking. And by the way, if you never take a policy loan, that's okay too. You're still going to grow your money. But the idea is if you can go out and buy assets, whether it's real estate or investing back into your business or other types of investments, you can use your policy cash value, take a policy loan, and go buy those assets.
Which everybody wants to be their own bank, right? They want to control their own money. They want to have the ability to have money that if they want to buy a rental property, or if they want to purchase a vehicle and pay themselves back, or whatever that investment is, how powerful is that to loan the money to yourself instead of having to go to a bank and go through the traditional finance and potential headaches there, depending on credit and all these things that people can run into.
That's right. And obviously, over time, there's more cash in the policy where you could purchase real estate all with the policy loan. But what about early on? What I usually tell clients is you might still need bank financing depending on the price of what you're purchasing. But what you can do is you can then use the earlier year cash value as the down payment portion. So here's an example. Let's say in the fourth year, you want to buy a property and the bank is requiring you to come in and put 20% down, and the purchase price is $300,000. So you need $60,000 as a down payment. You say, hey, I've got my infinite banking policy. I've got $71,000 of cash value. I'm going to call the insurance company. I'm going to request a policy loan, which, by the way, it only takes about 3 to 7 business days to have that money direct deposited into your bank account. And then that $60,000 is yours to use however you want. When you take a policy loan, the insurance company, they're not doing a credit check. They're not asking you to fill out a bunch of paperwork to take the loan. And they don't care what you use the money for. They're not asking you questions about where's the money going. But here's what's amazing. When you take that $60,000 loan, the insurance company does not physically remove the $60,000 from your $71,000 total cash value. They put a lien against it. What that means is you're still earning interest and dividends on your $71,000 total, even though you have a policy loan. So maybe you're paying 5% interest on the loan. You're still earning roughly 5% tax-free on the total of the $71,000 cash value.
Some of the most inexpensive money you can get, right? You're leveraging the use of your own money with the use of a mutual company's general account, because they're loaning it from their general account, right? And then they're just leveraging your death benefit and your policy against that loan.
It's so remarkable. Think about it from a tangible perspective. If you buy that $300,000 real estate deal and you're cash flow positive every month, you're making money in the real estate deal. And you're also making money on your full 71,000 in the policy. And people will say, well, Barry, I'm paying 5% interest. Yeah, but you're paying that loan down every month. So what that means is you're paying less interest over time. We call that principal reduction, but your full 71,000 is still compounding. So although you have a 5% loan and you're earning 5% in the policy, you still come out ahead because it's compounded money compared to principal reduction money. And at the end of the day, by using your policy to buy real estate or other investments, you create more wealth.
And that's something there's no other strategies out there. If you have a financial advisor telling you to put the same amount of money into a mutual fund, there's just the mutual fund in many different ways to compare, right? Just doesn't even have the leverage of the cash value, nor does it have the death benefit and the tax-free and all these things. But there's just no comparison to this strategy and using this policy.
Yeah, and I'm glad you mentioned the death benefit. People might say, well, I'm not really interested in the death benefit. We want to minimize it. Matter of fact, this particular policy only has a $206,000 whole life base face amount. But notice the death benefit is growing every year. Even though the client only paid for the 206, they still get this growing death benefit. Well, what we tell clients is don't discount the death benefit. Most of you have families out there. This is permanent life insurance. It's not term insurance. It's not going to go away when you turn 60 or 65. And none of us know when we're going to pass away. But we teach clients, Ira, how to leverage the death benefit. They leverage it through policy loans. And then we're going to get into retirement where they don't have to pay those loans back and the death benefit comes a collateral piece for them. But think about this. If you've got $1 million or $2 million or $3 million death benefit in your portfolio, it's a permission slip. And this is what was taught in LEAP. It's a permission slip for you to spend and enjoy all of your other assets. Because if you knew whether you passed away at 75 or 105, and your family is going to get a $2 or $5 million death benefit upon your passing, you're going to feel that freedom, that permission slip to go spend all of your other money.
That concept, again, years ago, when I was told that concept of leverage the death benefit, that alone was a game changer for me because I would always get clients who would say, I'm just going to build up my assets and I'm just going to spend it all. I'm not going to leave any to my kids. We always get the joke, I'm just going to spend it and not give anything to the kids. But we all know, unless we have a crystal ball, you're never going to be able to spend that. And honestly, most people with a traditional strategy never spend hardly, what's the percentage you guess somebody would spend of their assets in a traditional investment strategy?
Well, we know in most cases, it's not all of it. They are leaving something behind, if not a good majority of what they have.
Yeah, so they're going to pass that to their kids anyway. They're just not passing it, or they're maybe not kids, their legacy or their through their estate. But this is just another way to give them that permission slip that says, look, like you said, spend and enjoy all those assets that you built up, because anything that you spend and enjoy is going to get recreated by the death benefit of this permanent guaranteed product.
That's right. And if you're a real estate investor out there listening, you can use this death benefit with a bank as a collateral assignment. Banks love permanent whole life insurance. So you walk into a bank asking for a loan and you say, hey, I can put up a $900,000 whole life death benefit as collateral. You're a more advantageous borrower and you're more likely to get and borrow more money.
Which is amazing, right? That, again, we're talking about banks and institutions. They understand the value of these policies and they invest huge amounts into their portfolio and they're purchasing these policies. But a lot of times clients are told that these type of policies aren't a good investment. But here you have some of these major banks in the world that own a ton of life insurance in their portfolio.
They sure do. Billions and billions of dollars worth. Ira, let's talk about income. How can clients in their later years use the cash value as income. We'll look at a policy and talk about tax-free income using their same whole life policy that we've been discussing.
Yeah, let's do it. I mean, again, who wouldn't want tax-free income in retirement, right?
Yep, especially with what we saw with the US debt clock and the increase of seems like trillions and trillions every few years. Here's our 42-year-old male, 20,000 a year, and we're showing him putting in the 20,000 a year through the age of 70. But at age 71, notice this column that says total premium. He's not putting in any more money. He's done funding. No more money coming out of pocket from him, but he's now going to begin taking out $78,000 a year. Now, the rule of thumb, this isn't 100% all the time, but the general rule of thumb is he's first going to withdraw the $560,000 contribution that he put in. At $78,000 a year, that lasts a total of 7 years. At that point, in the 36th year at age 78, the $78,000 still comes out, but now it's in the form of a loan. And people say, oh, I don't want a loan because then I have to pay it back. Yeah. In retirement, you don't pay the loans back. The loans and any interest accrued will come off of your death benefit. So we want to help people see that, yes, you're going to take policy loans early on in the policy to buy real estate, to invest in your business, to buy other types of investments, pay those loans back, be an honest banker. But in retirement, don't pay the loans back. And this is where you're able to use the death benefit as collateral. We're showing the income from age 71 to the age of 90. And we just have to assume some age at which he's going to pass away. We're going to use the age of 90. And let's do some math. We know he put in a total of $560,000. Those were his contributions over a 28-year time frame. And he's able to pull out $78,000 a year for a total of 20 years. So we're going to take the $78,000 times 20. And Ira, look at this. He's put in $560,000 and he can take out $1.56 million completely tax-free. And upon his passing, he would still leave his family a tax-free $324,000 death benefit. So boom, there you go. So remarkable.
It is awesome to be able to put that type of investment in, take that much out, and then you're still leaving something, to your estate or to your family. It's so powerful.
We want people to understand that having this in their portfolio, not only is the peace of mind better, the taxation is gone, the guarantees are there, but what does this do for your overall family? What does this do for your overall life?
This is going to enhance other assets and other investments they have too, because most obviously aren't going to just do this. This is just going to help enhance and give them more flexibility, more options, tax-free, and help with the whole strategy.
Such a great point. And we want people to see, look at this amount of income. How many of you out there would want this amount of income? And imagine, what if you put in $40,000 a year and you can pull out $3 million of income? What if you put $80,000 a year into a policy and you can pull out $6 million of tax-free income? Whatever premium amount you choose to go with, that's up to you. But Ira and I, we're going to encourage you to put in as much as you can. And now we're showing you exactly the reason why you want to overfund these policies to the highest level possible.
People just hear life insurance and sometimes they'll just shut off their mind to it just because, again, they've heard it's not a good investment. They've heard that it's not a good thing. But these are the numbers. These are what's happened. And these policies and these companies have been around for 100 plus years to prove it. So it's not something that's new. It may be new to the investor that's just learning it, but these strategies have been around for years and years and years.
Great segue, Ira. Let's talk about, in combination, all of the benefits you get and ways to use infinite banking. We've touched on some of these today. There's access to liquid cash, loans for business, real estate, other types of investments, etc., guaranteed growth of your money, you never have to worry about losses. You're always making more money from one year to the next. And Ira, a lot of people are going to love this, especially business owners. In most states, they have creditor protection and bankruptcy protection, that the cash value and the death benefit are protected. Pension maximization, we can show people actually, if they have a pension, how to get more money out of their pension. They can pay off higher interest rates. Loan rates today with these mutual companies range between 5 and 6%. I'm sure someone listening today, if not several people, have interest rates that are higher than 5 or 6, maybe 10, 12, 20 plus percent, that they could use a policy loan to pay those higher interest rates off. Asset protection, estate planning, tax-free retirement income we just showed, on and on and on. Ira, what do you want to talk about in regards to any of those benefits?
We've talked about the loans and what can be created as far as outside investments. But I mean, the creditor protection, that's just something you get with this. And most assets are not protected. Unfortunately, back in 2008, 2009, we as advisors all went through that with our clients, and we went through it. It was painful. And I had clients, unfortunately, that did have to claim bankruptcy with, their situation, and they had policies in place that was protected from those bankruptcies. So that's how they were able to get back on their feet and back up and running quicker, as they had the values here that were protected and the bankruptcy didn't touch. And so it just helped them to get going. Things you wouldn't ever think or you would hope would never happen, but it happens.
It does happen. And some of that's even true with the asset protection or estate planning, like legacy planning. People may not be fully thinking about their future 20, 30, 40 years from now. But what I've seen over and over again is when someone has whole life insurance and they're using that for an estate plan, it's the way to go. You would never want to use term insurance for an estate plan or legacy planning because those policies will expire. The whole life policy, it's with you, as we said, whether you pass away at 75 or 105.
Like you said, you brought up legacy. How powerful could that be if you have a policy or policies that now you're able to leave a legacy that it goes on for generations and potentially can help through those generations in your name and create that for your heirs, for your legacy.
And I've had a number of clients who then get policies on their children and grandchildren. They see the power of this and they want to perpetuate that wealth generationally. And if done correctly, Ira, we show clients how the next generation can have more wealth, and then the generation after that can have more wealth because of this type of planning.
Yeah, and most people would say, well, we don't want to make our kids rich. We want them to earn. But let's be honest, if there's a way that you can pass on tax-free cash, make life easier on them, to me, it's a no-brainer. It's something that's going to happen anyway, but you're going to get all the benefits and the living benefits as you're alive anyway. Just different ways to maximize.
It is. And if those people have a trust, they can actually control that money beyond their passing. If they don't want their kids spending all of it quickly, they can put those safeguards in place through a trust. Well, Ira, I hear this often. Why have I never heard about this, Barry? Or why isn't this more popular? It's actually more popular than people think. We want to talk quickly as we wrap up about social proof. And Ira, you mentioned earlier, most banks are using these high cash value policies as the foundation. They want the guarantees. They want the access to liquid cash. So all of you watching the webinar today, you know these companies, you know these banks, you know these businesses. These are companies and banks that use high cash value insurance. You can go to like the FDIC website and you can see Wells Fargo, $12 billion of life insurance assets. Bank of America. There is social proof out there. We're just scratching the surface with the list that you see here, but the social proof is everywhere.
Yeah, and that's what I love about this. A lot of people will say this isn't a good investment, but like you say, this is social proof that some of the biggest, most powerful companies in the world are using the same type of strategy. The proof's in what's being used, right?
Exactly. We want to thank everyone for attending the Infinite Banking webinar. And we want to encourage you to look at your own numbers. Ira can design your illustrations. For more information and to see your own numbers, you can contact Ira through email, through the phone number.
Yeah, thanks for taking the time. It's always great to chat with you. And that's what we're here for, is to help expand people's knowledge and help them understand that this is something that anybody can do. They just need to get in touch with somebody like us, and we can teach them how to do it.
Thank you, everyone. Appreciate you listening today. Take the next step, move forward, and look at your own numbers.